Everyone is talking about the massive SpaceX IPO this week, but almost every retail investor is walking straight into a trap. Hey, welcome back to MarketSnap. Today, we're breaking down the biggest market moves for the week ending June 12th, 2026, and looking at which stock swings were legit and which were pure hype. But make sure you stay until the very end, because we're diving into a hidden mechanism in the SpaceX launch that early investors are completely blind to right now, and it changes everything. Let us start with the broad picture. It was a quietly positive week for the major indexes, with the Dow up about 0.7%, the S&P 500 up 0.5%, the Nasdaq up roughly 0.3%, and the Russell 2000 leading with a gain of nearly 0.8%. The VIX dropped 9%, signaling that fear was easing off. But beneath that calm surface, the sector rotation was dramatic. Consumer defensive stocks surged more than 4%, and consumer cyclical names added over 3.5%. Real estate and financial services also posted solid gains. Meanwhile, technology got hammered, falling more than 4.5% for the week. Energy dropped over 2%, and healthcare and basic materials both slipped. The leadership was concentrated in a few niche industries. Department stores jumped nearly 36%, medical specialties rose over 28%, and food distribution gained more than 9%. That is a defensive and value-driven tilt, not a growth rally. On the earnings front, it was a quiet week with roughly 440 companies reporting, but 0 beats and 0 misses so far, which is unusual. That suggests the bigger market moves were simply not being driven by a broad earnings wave. The real story was in the headlines. Gas prices are easing, which lifted consumer sentiment from an all-time low. There is also a lot of chatter about value stocks beating growth by a wide margin, and one headline asked whether AI token spending is crashing, signaling trouble for the sector. That tech weakness showed up in big names. Supermicro dropped over 32%, Cloudflare fell nearly 15%, ServiceNow lost over 14%, and AppLovin dropped 14%. On the flip side, Chipotle gained nearly 11%, United Airlines rose over 10%, and Dollar General added 10%. The moves look concentrated in specific sectors rather than broad-based, and investors seem to be rotating out of high-multiple tech into staples and value. Now, stepping back for a longer-term view, weeks like this can be misleading if you only focus on the price action. The sell-off in technology may reflect a repricing of AI expectations rather than a fundamental collapse. Some of those names had stretched valuations, and a few negative headlines were enough to trigger profit-taking. But the data center boom is still driving renewable energy deals and corporate investment. The question is whether the market overreacted to a single data point or whether the trend has actually shifted. Similarly, the surge in consumer defensive stocks might be a temporary flight to safety, not a permanent rotation. When you see a 35% weekly gain in department stores, you have to ask whether the business reality changed that much in 5 days. Usually, the answer is no. That is the kind of gap we want to examine. So for the rest of this episode, we are going to walk through several stocks that made big moves this week, and we will judge whether the market got it right or wrong. We will look at the numbers behind the price, the earnings or news catalyst, and whether the valuation now makes sense. And then we'll finish with SpaceX, because its IPO tells us something important about market appetite for huge growth stories right now. Stock number 1, Roku, ticker ROKU. Shares surged more than 15.5% this week, making it our featured mover. The rally came on massive volume, 6 times the average, while the broader communication services sector was basically flat to slightly down. So this was not a sector move. Roku moved on its own catalyst. The big catalyst hit Friday afternoon. Bloomberg News reported that Roku is in sale talks, including a possible media tie-up. That takeover speculation alone explains the weekly pop. Earlier in the week, the company presented at the Evercore Global TMT conference, and there were some bullish analyst notes circulating, but the buyout chatter is clearly the main driver. Here is where things get tricky. MarketSnap's model currently prices Roku at about $143, but pegs fair value at roughly $89. That implies a downside of about 37% from here. The model's base 5-year CAGR is negative 9%. meaning the valuation forecast expects the stock to lose value over time unless the business accelerates. Was the move deserved? Takeover rumors can send any stock higher, but the math here is stretched. Even with a potential sale, the current price already prices in a significant premium to what the fundamentals suggest the business is worth on its own. The market is betting on a deal, not on operating improvement. What to watch next? First, any confirmation or denial from Roku or potential buyers will swing the stock hard. Second, if no credible follow-up emerges, the stock could give back part of this week's gains as the valuation gap reasserts itself. Stock number 2, Adobe Inc., ticker ADBE. This stock was our unusual volume pick this week, and it certainly delivered on that front, just not in a good way. Adobe shares plunged 21.3% for the week, bringing the one-month decline to 15.3%. But the bigger picture is even more dramatic. Adobe has gone from roughly $400 to around $200 over the past year, so this is not just a one-quarter reaction. It is a full valuation reset. The catalyst was a brutal earnings week that ended June 12, 2026. The company actually beat earnings estimates and raised guidance, but that didn't matter. Investors focused on two things: the surprise departure of Adobe's CFO to Marvell Technology and a strategic shift toward freemium AI products that leaves key monetization questions unanswered. Headlines screamed about the stock hitting its lowest point in 8 years, with analysts questioning whether Adobe can survive in the AI era. MarketSnap's model shows the stock at roughly $204, with a fair value estimate near $419, implying about 105% upside. The base 5-year CAGR projection sits around 15.5%. So was the move deserved? Partially. A CFO exit and uncertain AI monetization are real concerns. But trading at about 14 times earnings for a company that is still profitable, still growing, and still generating strong cash flow? That feels like the market is pricing in a very dark scenario that has not materialized yet. What to watch next? First, whether Adobe can articulate a clear AI revenue path on its next earnings call. Second, watch annual recurring revenue trends, because usage is not enough if it does not convert into durable revenue. Third, watch for insider buying. If executives start buying at these levels, it would be a strong signal they see the sell-off as overdone. Stock number 3, Oracle Corporation, ticker ORCL. Oracle shares tumbled 19.8% this week, making it the second biggest large-cap loser of the week after Supermicro. The sell-off came despite what headlines called a record earnings beat for the fiscal fourth quarter. So what spooked the market? Multiple reports point to the same culprit: spending. Oracle guided to roughly $70 billion in capital expenditures for fiscal 27, plus another $20 to $25 billion in prepayments. Analysts and commentators flagged that heavy AI investment is crushing free cash flow and raising dilution fears, even as the company's cloud backlog swelled past $630 billion. One CNBC analyst said the mood around Oracle felt like 1999 again. A security vulnerability in PeopleSoft software added to the negative tone. At the close Friday, Oracle shares sat near $184. The MarketSnap model pegs fair value at about $210, implying roughly 14% upside from here. The model's base 5-year CAGR is just under 3%, a modest growth forecast that reflects the heavy spending phase. Was the sell-off deserved? The earnings beat itself was solid, and the backlog is enormous. But the market is clearly questioning whether Oracle can turn that massive spending into timely revenue growth. A nearly 20% weekly drop is aggressive, but Oracle had become a crowded AI infrastructure trade. When investors start worrying about capital spending, margins, dilution, and cloud execution, the stock can reset quickly. Watch for two things in the weeks ahead. First, any signs that the OpenAI partnership is translating into actual cash flow. Second, whether management provides more detail on how the capital spending will ramp down once the data center build-out peaks. Stock number 4, Autodesk, ticker ADSK. This stock fell more than 15.5% this week, making it one of the biggest losers in our coverage. The drop came despite a strong earnings beat and raised guidance, which shows you how much the market is focused on execution risk and strategic uncertainty rather than just the latest quarter. The stock also fell more than the sector, which was down nearly 12%, and volume was nearly 3 times normal, confirming real selling pressure. This looks like a mix of broad software sector weakness, macro rotation out of higher multiple names, and investor skepticism around Autodesk's expansion beyond core design software. According to the MarketSnap model, Autodesk now trades around $198, with a fair value estimate of about $263, implying upside of roughly 33%. The model's base 5-year CAGR is about 5.8%, which is a valuation forecast, not a sign of shrinking business. Was this sell-off deserved? Partially. Autodesk is still a high-quality software company, but the market is punishing uncertainty. When a stock drops this hard on good earnings, it tells you the narrative is broken for now. That does not mean the business is broken, but it does mean investors want more proof before paying a higher multiple again. What to watch next? First, listen for more details around margins, enterprise demand, and the company's longer-term expansion strategy at the next earnings call. Second, watch whether the stock can hold the $200 level, because a break below that could trigger further selling from momentum funds. Stock number 5, ticker SPCX. And finally, SpaceX. This was not just another stock move. This was the headline IPO of the week and probably one of the biggest IPO events the market has seen in years. SpaceX priced its IPO at $135 per share, selling about 555 million shares and targeting roughly $75 billion raised. That puts the company at a valuation around $1.75 trillion, which is enormous even by mega-cap tech standards. The first thing to say is obvious. SpaceX is not a normal company. It sits at the center of several huge markets at once: rockets, satellites, Starlink, defense, space infrastructure, and potentially future launch economics that no other company has matched at scale. So from a business quality perspective, it is one of the most important companies to ever come public. But that does not automatically make the IPO price attractive. A great company can still be an expensive stock. And with SpaceX, the market is not just paying for what exists today. It is paying for years of expected growth, execution, and dominance across multiple industries. That is why this IPO matters beyond SpaceX itself. Strong demand for a listing this large tells us investors still have appetite for massive growth stories, even in a week when technology stocks were under pressure. But it also shows how selective that appetite has become. Investors may be rotating out of weaker or more crowded tech names while still chasing the companies they believe can define the next decade. Was the move deserved? From a market attention perspective, absolutely. SpaceX deserved to dominate the week. From a valuation perspective, I would be more careful. At this size, future returns depend heavily on execution. The company has to grow into a valuation that already assumes a lot of success. What to watch next? First, watch how the stock trades after the IPO excitement fades. The IPO structure matters here because SpaceX uses a staggered lockup rather than one simple insider selling date. That can limit supply early on, but it also means more shares may become available in stages as restrictions expire. So the real test is not just whether the stock holds above the IPO price in the first few days. The bigger test is whether demand is still strong once more insider and early investor shares are allowed to trade. Second, watch the early analyst coverage because the first wave of price targets will shape the market narrative. Third, watch how other space and defense-related stocks react. If SpaceX absorbs too much investor attention, smaller space names could actually struggle even while SpaceX itself performs well. And that wraps up this week's MarketSnap. Roku jumped over 15% on sale speculation, but the valuation is looking stretched unless a real deal emerges. Adobe dropped 21%, yet the fundamentals remain intact and the sell-off may be pricing in a very dark AI scenario. Oracle fell nearly 20% as investors question the cost of its AI infrastructure build-out. Autodesk lost over 15%, but again, the business does not look broken. The market is punishing uncertainty. And SpaceX dominated the week with a historic IPO, reminding us that investors are still willing to chase huge growth stories when the story is strong enough. Remember, none of this is financial advice. Use these tickers as a starting point for your own research. Check the description for links to the MarketSnap screener and our intrinsic value tools to run your own numbers. Thanks for watching, and we will see you next week.